overarching all of that, the commitments that we've made for cash flow break even and profitability are our sort of guiding light here. And in order to deliver that, two things need to happen. Costs managed, we've done that. Costs have been reduced by more than $1 million a month and are flowing through into our accounts. And growth.
Hello, you're watching Proactive. Joining me is Seeing Machines CEO, Paul McGlone. Paul, very good to speak with you. Could you give us your general view on the KPIs released in London yesterday?
Stephen, thank you. Yes, the quarterly KPIs for Q4, we're really pleased with the results. There are two key items to call out. We've seen quite a dramatic recovery in our automotive royalties, which we have been expecting. So it's good to see that that's now happening. 36% growth quarter on quarter there, which is very important. And we're starting now to see sales come through in our Generation 3 aftermarket product. We did just over 2,500 units. So again, that is pretty consistent with our own expectations and the expectations that we've provided to the market. So quite pleased with the result. And I do expect that momentum will continue right through to the end of this financial year.
Paul, can you elaborate on the growing demand in aftermarket for Guardian Generation 3?
Yes, so I think it's very well known that we were delayed in bringing that product to market for a whole range of reasons. But we do have a very, very strong level of demand. We're beginning to approach our quarterly production capacity of between 6,000 and 6,500 units, and that's the target that we're looking to sell by the end of this calendar year, and then build from there. Of the three regions that we operate in, there is really quite a different profile. In the Americas, we have two distributors and one resale agreement, which is through Mitsubishi, as we've published before. But the big effort there is direct, and we have a very strong pipeline of large direct opportunities. So I'm really quite confident that we'll, over the course of this calendar year, see some real strong results there. EMEA is quite a different mix. Of course, we have about 6,000 or 7,000 trucks connected there already. But we're looking at, obviously, in the lead up to GSR, that's a very, very strong opportunity, dealing with the OEMs, a really strong focus on new business and also new distributors. In Asia Pacific, a very, very strong customer base and a strong distribution network. But the single biggest near-in opportunity is expanding penetration in existing customers. But a lot of the trials that we're running around the world, and there are roughly 20 of those at this point in time, they're all with new customers. So we feel pretty good about the prospects over the course of this next 2 quarters.
And in automotive, are you expecting RFQs to finalize in the short term?
Yeah, look, this has been one of life's great disappointments, I think, trying to predict RFQ award dates. So as I've mentioned before, we respond to an RFQ. We have multiple rounds of negotiation on price and technical issues. We get given a date, and that date, certainly in the last year, has moved constantly. Of the RFQs that were most near in a couple of months ago, they butted up against the European summer, so we didn't get to close anything prior to the end of July, as we thought we would. But we are very hopeful that they will close as our key customers in Europe return to work. So the RFQ pipeline is actually really strong. What's most important right now, though, is that the programs that we're working on hit start of production. They are all hitting start of production in time. And there's 2 factors that are going to drive royalty growth. GSR with existing customers, mandated, and new programs that we have hitting start of production. And that is the consequences of our effort in developing these programs. So that's really the picture on automotive.
Paul, looking back at your recent town hall in London, where you announced some cost management initiatives, do you have an update on that?
Yes, I do. So there were really 3 key points that we made at the town hall. And the key objective that we talked about was to getting to our cash flow break-even run rate at the end of this calendar year. And we are absolutely on track for that. So what were the three issues? One is we wanted to see automotive royalties by the end of this calendar year in the 7 to 750,000 per month range. We wanted to see us selling our current capacity of Guardian Gen 3 units, 6 to 6,500 per quarter, and reduce our monthly operating costs by $1 million. Now, I'm really pleased to say that we've reduced our operating costs by just over $1 million. That's booked, in place, and we're seeing that flow through into our monthly accounts already. If we look at the automotive royalties, we posted a 36% Q-on-Q growth for Q4. If that growth rate just maintains at, say, 20% for the next 2 quarters, we'll be right in the middle of our 700 to 750,000 range per quarter. So the cost work is done. We can tick that box, and now it's all about royalties and Gen 3 sales, and we're feeling more and more confident month by month.
Paul, what's next for Seeing Machines?
Wow. Well, look, I think what's going to be very interesting for us and for everybody is as we watch European car sales. I mean, the top 3 OEMs by sales volume in Europe are our customers. So this is really important. Then we have GSR underpinning that. So we're very focused on program delivery performance to drive royalties in those customers. That's very, very important. But overarching all of that, the commitments that we've made for cash flow break-even and profitability are our sort of guiding light here. And in order to deliver that, 2 things need to happen. Costs managed, we've done that. Costs have been reduced by more than $1 million a month and are flowing through into our accounts. And growth. And the 2 areas for growth are royalties and Gen 3 sales. Highly confident now in the royalty growth rate between now and July 26 when GSR kicks in. There may well be quarterly fluctuations, but it seems like the trajectory is pretty well locked in. And so for us now, it's engaging the new sales teams that we have in Europe and the Americas and our existing and new sales channels to push the Guardian product. And that's really a primary part of our focus.
Well, Paul, I hope you'll continue to keep us updated with your progress. Thank you very much for taking the time today.
Stephen, thanks very much.
Paul McGlone, CEO of Seeing Machines.